All right. Hi, everyone. I know it's the close of the end of the semester already, so we really appreciate everybody joining us today. This is one of our second to last webinars for the semester. So today's presentation will be on taxes and estate planning. I'm here with Samuel Molina from Binational of Central California. He's here again to present. So we are recording the session in case people need to log off a little early. We will post it on our website within the next week or so. But if people have any questions, feel free to use the chat box or the Q&A option as well. But I will go ahead and turn it over to you, Samuel.
Hey, good afternoon, everyone. As Martha shared, my name is Samuel Molina. I am the Deputy Director with Binational of Central California. In my previous role with Northwestern Mutual, I was a financial advisor, was investment license, Series 7 license, life and health license, and received a certificate in personal financial planning from Dalton Education. Today, what we're going to go over is some basics around estate planning and tax planning. And before I start sharing my screen, I do want to let you all know we do recruit volunteers. So if you're interested in volunteering with us, you have my information there in the chat bar, my phone number and email address. And then also, I'd really appreciate it if you could sign in on our sign-in sheets. We do have a link there on the chat bar as well. It does really help us out when it comes to letting folks know who we're serving, right? And the other thing I'd like to add is that if you have questions at any point in time, feel free to ask them. Put it in the chat bar. I will pause for questions because I don't want you to forget them. Okay. Sorry for about this brief. You all see my screen?
Yes, we are.
Okay. So one of the first things I like to always do is talk about why you should begin planning, right? I understand most of you probably, under the age of 30 and, maybe 19, 20 years old, and planning is something you haven't really been thinking of. But there are several different reasons why, this is not an exhaustive list, but just to get you, thinking about planning, I always say, we have to plan for taxes, right? Tax rates will go up. We have to pay for the pandemic, all of the money that we distributed, right? We know that inflation is always eating at the value of our income, right? The money that we have saved. Healthcare costs only get more expensive as we get older. So for those of you who may or may not be aware, last year, the inflation rate was about 6.5%, and healthcare and education are generally double what the consumer pricing index is. So you can imagine it's probably going to be around 10 to 12%, right, in inflation rate. Lifestyle changes, education planning, right? You might be getting your AA bachelor's degree, what have you, or some certificates. But if you decide to go back for your master's or your doctorates, education again is just going to become more expensive. We always want to plan for market volatility, right? Emergencies. And I know we just got an influx of water, right? A lot of water, but drought is still always something that we have to be concerned about. So financial planning is like planting a tree. It's going to take some time for it to bear fruit. That's why the sooner we begin, the better. All right. The other thing I want to go through before we begin on the taxes and estate planning. Some of you may have seen this before if you've been a participant in my presentations, but this is the wealth accumulation phase, right? We should be planning for 4 different time horizons. We have our emergencies where we have money saved for 3 to 9 months, right? On average, it can take you 6 months to find a new job. During the 2008 recession, people were out of a job for maybe a year or more, right? And during the pandemic, we had a similar situation where many people were out of a job, right? So we always want to have an emergency savings. If you have $3,000 worth of bills every month, you want to have at least $9,000 in savings. Again, money sitting in our savings account generally isn't staying ahead of inflation, right? Usually that money in our savings account is growing at a 0.01% rate. So that's where you'll start looking at things like mutual funds, buying into the stock market, bonds, right? We want to keep our money ahead of the inflation rate. Anything that's 10 years or more, we want to have permanent life insurance or real estate, right, to help us weather the storm when the markets are down and help complement that retirement planning. And again, these are for goals that are 10 years plus. And then we also have our retirement accounts, right? 401ks, your 403b or 457, and the SEP IRA, these are all pre-taxed accounts, right? That we cannot touch until we're in retirement age. And then we also have a Roth IRA, right? It's taxed today, it won't be taxed tomorrow. And then below all of this, right, we want to make sure that we're protecting our income. So we need to make sure we have the appropriate insurance policies in place. Whether that's life insurance, right, to leave behind for, our families in the event that we pass away. We want to make sure that, funeral expenses, any debts are paid off. Disability insurance to protect our income, right? Just because we're unable to work doesn't mean we don't still have bills to pay. So you want to make sure that you're protecting your income. Long-term care insurance, right? If you have a family history of needing care, Parkinson's, Alzheimer's, dementia, things like that, you want to make sure you have some kind of long-term care insurance to pay for those expenses. And then of course, car insurance and homeowners and renters insurance. At any time we don't have these policies in place, all of the great planning that we've been doing between the savings and the investments, you'll see that those monies will drain very quickly, right? So that's why we want to make sure that we have the appropriate income or insurance policies in place. Martha, do we have any questions so far?
No questions. I think it was just about the attendance. So I just make sure to let people know that you're tracking attendance, but so am I. So just an FYI.
Got it. Okay. So when it comes to income tax planning, right, there are several key terms that we need to be mindful of, right? When you're filing taxes, you're a single person, right? Single unmarried person, head of household, right? This may be more favorable for you if you're the head of household. You're still unmarried taxpayer, but maybe you have a qualifying child or maybe a qualifying dependent, right? So this can lead to having a greater, more favorable deductions. Married filing jointly, right? As long as you're married, you should be filing jointly unless there's other mitigating circumstances, or you might be married filing separately, right? But it's important to be familiar with all of these terms and what is going to be applicable to you, right, when you're filing your taxes, because you want to make sure that you're reducing the tax liability as much as possible or getting the greatest refund as much as possible, right? You're not having to go back and refile because you missed something. Again, you have married filing separately. A married taxpayer can elect to file separately for any reason. This may be necessary if the husband and wife are separated at the end of the year, right? The spouse. And then we also have surviving spouse or qualifying widower, right? You have the same basic standard deduction and tax rates as a married filing jointly group. And you can do it as long as the person died in the preceding 2 tax years, right? So again, at certain time, eventually you'll start filing either head of household or as a single person, depending on what it might be. You'll notice here on the slide again, taxpayer must maintain a household as their home, which is also the principal place of residence of a dependent child. Taxpayer has not remarried, right? And taxpayer and spouse were eligible to file a joint return for the spouse's year of death, right? So again, at the bottom of the slide, you'll notice you can go to www.irs.gov/help/ITA, right, for any questions on this. Now, these are the 2023 federal income tax rates, right? For single filers, for married filers. Again, this will help you understand what percentage of your income is going to be taxed. It's important to note, and this is what I like to share with everyone, is that you want to make sure that you bring your tax liability, everybody's goal when they're filing their tax returns should really be at 0, right? Not that you owe the government any money, but also not that you're getting a refund. And the reason why I say that is because $1 today is worth more than $1 tomorrow, right? So if you're in a position where you're getting $3,000, $5,000 back in returns every year, well, on the flip side of that, that 3 or 5 grand could have otherwise been invested and been growing on interest the entire time. So it's very important that you are documenting how much you're paying in taxes every year, how much you're getting in refunds, so that you can become closer to 0, right? Again, because if you're getting $2,000, $3,000 in refunds every year, again, you want to make sure that maybe you're investing more into that 401k or to that pre-tax retirement account that's helping you reduce your tax liability, but also helping you plan for retirement, right? And it's growing. Any questions on that? And I hope I explained that clearly. Okay. Standard deductions, right? For this year, you're gonna have single 13,850, married filing jointly 27,700. You have head of household 20,800. Again, that's that. As I stated earlier, if you're head of household, you get a more favorable deduction amount. When you're paying taxes, you have Social Security and Medicare, right? As the employee, you're generally paying about 7.65. For that, if you're an employer or business owner, right, you're paying about 15.3%. So generally, when you're looking at your pay stub, you'll notice that you're paying your share and the employer's paying the other share, right? But if you're the business owner, you're paying it all together. We also have capital gains. For those of you who may be investing in the stock market, you'll notice that if you're single and you make less than that $44,000, there's a 0% income tax, right? At the moment that your tax liability becomes over $44,625, then you're going to get hit with that 15% taxable income, right? And then also 20% if you're making over $492,000. But it's important to note that this is the long-term capital gains rate, right? So assuming you hold on to that stock for more than 1 year, then you're going to get taxed at that 15%. Right after 13 months and you've sold it. But if you if you buy a stock and you sell it less than 1 year, then you're going to get hit with what's called ordinary income tax rate. So if your ordinary income tax rate is 22% and you bought a stock and sold it 9 months later, then you're going to get taxed at that 22% rate, not the 15% rate, right? So it's important to be mindful of that when you're buying stocks, right? Is this something I'm buying for the long term? Can I hold on to it for more than 13 months? Or is it something that the stock's really high right now and I need to sell it, right? You have to determine that. Martha, I see some questions.
Yes. Are you able to see them, Samuel, or want me to read them out to you?
How about a head of household sole proprietorship scenario? Laura, how do you mean? As a business owner? Well, if you're a business owner, right, I think you're filing two different types of, you file taxes for both your business, right, and then you have your personal situation. So again, I would really refer you to a tax professional to help you out on that, to answer those questions. I hope I also answered your question clearly about capital gains, right? Capital gains is just essentially you bought a stock at $10, you sold it at $25, so you have $15 of capital gains, right? That's what it's referring to. Okay, when it comes to, again, your income tax planning, right, we have deductions and we have credits. It's important to know the difference between both. The list that you're seeing in front of you is not an exhaustive list, right? Again, you can go to irs.gov/credits-deductions-for-individuals, right there that you see at the bottom of the screen. Credits can reduce the amount of tax liability, right, that you owe, and deductions can reduce the income tax, right? So you made $70,000, you have that standard deduction of, I believe it was about 13 grand, right? So now the tax that you owe, the income that you're reporting is 67 grand, right? Because of that deduction. Whereas credits, for example, I purchased solar last year and I got about 30% in tax credits off of my purchase. So therefore, when I went to go file taxes this year, I think I had about $14,000 worth of credits. So these credits, because I was a business owner last year, right? I was going to owe the federal government about $2,700, $3,000, somewhere around there. But because I had these solar credits, it reduced the taxes that I owed down to zero, right? And because I still have leftover credits, I can actually carry this over for the next 3 to 4 years, right? I think actually 5 years. So as long as I have these credits, I can use them when I'm filing taxes in the event that I actually owe anything back, right? I hope I explained that clearly. Any other questions? So we have, again, you see on the left side, we have family and dependent credits, right? Child tax credit, earned income tax credits. You know, if you're a business owner and you need some deductions, right? It's important to save the receipts for anything that you purchase. You know, you're going on lunches, you're going on seminars, right? You want to make sure that you save that. If you're a homeowner, right, the interest that you're paying on that home loan can help you out as well. Is this also, so credits roll over any type of credits? Again, you always want to talk to your tax professional about the credits. But it's generally my understanding, again, the credits that I have remaining, I still can use up for the next 4 to 5 years, right? Until either one, the timeline has run out, or I've reduced the amount of credits that I have available. Okay, estate planning. So when it comes to estate planning, right, there are several different types of trusts. We're only going to cover 2 today. I'm going to share a little story about mine. But it's important that you have a will or a trust set up, right? Especially if you have, you know, assets, right? If you're a homeowner, or if you have more than one home, you've got several cars, expensive collectibles, whatever it might be, you want to make sure that you're going to leave that to somebody, right? And so we're going to start off with a few key terms, right? We have a trustee. A trustee is an individual person or member, right, who's given powers of administration over property with a legal obligation to administer it solely for the purpose specified, right? And then you have the grantor. The grantor is the individual or entity that creates the trust. So I personally have a trust, so I would be the grantor. And the person that I've designated to execute my will would be the trustee, right? And that person can be anybody, a friend, a family member, right? Maybe another a business, you know, law firm that helps take care of it. We also have probate. Now, probate is a very public thing, right? If you don't have a trust set up, then it's more than likely that your assets and then the fighting is going to take place in probate. If you know, we always like to think the best of our family and friends, but once we pass away and there's stuff to be left behind, we never know what's going to take place, right? And so you want to make sure that you're avoiding probate as much as possible, because essentially what happens is, again, because it's a public event, anybody can be involved. So, for example, let's say you've left behind, you know, a house, you've left behind your cars, you know, a boat, whatever it might be, and somebody says, "Hey, this is so and so's baby," right? And he left everything to the baby. Well, then your family would actually have to figure out whether or not that is true, if this is really the baby. So it can really prolong the process, and it can become more expensive. There's also another scenario in which, you know, I was watching Dateline, and a gentleman was having an affair on his wife. He, you know, gets murdered. Nobody knows who did it, but 6 months later, a woman out of nowhere appears before the judge, asks to become the administrator of his estate, and the judge granted it. So again, she gets control over this estate, not a family or friend member, right? There was no trust set up, so no assets essentially went to the family because the judge granted her this power to become the administrator. So again, you want to avoid those kinds of things from happening. You have a will. When you have a will, it's, you know, it sets forth your wishes, right? Who gets what. The thing about a will is it's not as strong as a trust, right? It can still be challenged. Things will still end up in probate, right? But a trust is a fiduciary relationship in which the trustor gives another party, known as the trustee, the right to hold title to property or assets for the benefit of a third party or the beneficiary, right? So when you have a trust, you're going to have a will inside of it. right? You still have to have a will inside of it, but you're also going to have several other documents within it as well. So as I mentioned, you have several different types of trusts. Most people, depending on your net worth, right, only need one of these two trusts, and that's either the revocable trust, right? The revocable trust is where it can be altered while you're alive, right? So if I designate, a family member to take over my house, but then we have a falling out, we no longer like each other, we're no longer talking to each other, I can redesignate somebody else to take over the house, right? With an irrevocable trust, right? The thing there is once I've designated that family member and we have that falling out and I want to designate somebody else, I would actually therefore have to get their approval to change the beneficiary. So you may want to have an irrevocable trust for whatever reason, but just be mindful of the consequences of that, right? If things do end up falling out, you have a bad relationship, highly unlikely somebody's going to want to sign over the house that that they were the beneficiary for. And there can be other tax benefits, right, as you see on the slide. There can be some tax benefits to having an irrevocable trust. Christian, thank you for your question. When I started my trust, it's because I have a home, and I also have a family member who started a trust because they have life insurance policies. So it's really, from my understanding, is if you have $140,000 in assets, right? Good question. If you're a single person, right, a trust becomes even more important because you can have what's called a medical directive, right? Who's going to take care of you or make the decisions in the event that you're physically or mentally disabled, right? And unable to make financial decisions. Do we resuscitate? Do we not resuscitate? Those are certain things that you want to make sure that you take care of, right? Again, a medical directive, a will live inside of a trust. You have these other types of wills, statutory will, which is drafted by an attorney, complies with the statutes of the state, right? Generally must be witnessed and signed by the testator, right? You have holographic wills, which must be signed and dated, but the testator does not usually require a witness. And then you have what's called non-cubitive wills. These are oral dying declarations, generally before a significant amount of people, but it may not be valid in most states. So again, that's where you want to make sure that you're taking care of these things. At a minimum, you have a will ready to go, but as soon as you're able, right, to pay for the trust, you have that asset threshold. That's when you would set that up. There is a website called willsandtrust.com. They have attorneys on the website, right? I think it's about $600 to set up a trust, but they can also help you out with wills as well. Any other questions? Any other questions regarding taxes or estate planning? So one of the other things I'd like to share is that don't assume that everybody's taking care of their estate planning, whether it's your parents, your friends. Many celebrities actually don't take care of their estate plans, right? Philip Seymour Hoffman, I think it's Philip Seymour Hoffman, who passed away in 2014. He was a celebrity, lived in New York, right? Had an estate, I think, worth more than $30 million, but he didn't marry his partner. So when he passed away, his estate was taxed up to about 40% from New York, right? So he had the state tax income, and then he also had to pay for federal taxes. So essentially, because of taxes, the family inherited, less than about 40%, right, of the estate. So it's important to be mindful of, unlimited marital deductions, right? Had he married his partner, the estate would have passed to her without those taxes. right? Because then it would have passed to her. Once she passed away, then the family would have had to pay taxes on it, right? Or if he had a trust set up better, again, he would have avoided certain tax consequences. But unfortunately, because he didn't have that trust set up and some of the estate planning done, a lot of his estate was ultimately taxed. Any other questions?
So in regards for any on-campus program at Fresno State Money Management Center, so myself, I'm taking attendance. So everybody will get credit for attending today's webinar. So you don't have to submit anything on my end.
Yeah. Matthew, Laura, there's that website called willsandtrust.com. Hold on, let me get you guys the link. But you can always just type it into the your web bar and you'll find it. Sorry, it's actually trustandwills.com. And then Christian, in the beginning of your presentation, you mentioned that it's best to maximize your tax return so you can invest that money. How can we track if we will be getting a return and intern plan to minimize the return like you mentioned so we can invest it? Well, one of the things you would do is take a look at the tax returns that you've already filed, right? And determine how much you paid in taxes. Also, at the end of the year, when you receive that final pay stub from your employer, right, it has everything that was paid out to you. It has your gross income. It ultimately has your net income and what was saved and deducted for taxes, right? So I would start studying those materials and create an Excel document to look at, where all your monthly expenses were this year. I'm sorry, this past year, what were your monthly expenses? What were the taxes again allocated to? And then how much money you put in investments and retirement accounts, right? Again, so that you can take, if you make $40,000 and you have a whole year's worth of expenses, including those taxes, right? You want to be at the balance of zero, right? Again, so then you maximize your income throughout the entire year. You're not going to owe, but you're also not going to get anything back, right? So it's going to take some homework on your part. Any other questions? Well, I hope you guys found this conversation very valuable today. I know it was very brief, but you have my information. Again, love to hear from you. Love to have more conversations. We do one-on-one coaching and online curriculum for our clients at any point in time. There are a lot of other services that we offer, like pre-tax services if you make less than 60,000 and what have you. So again, I'd love to hear from you guys and see how we can be of help.
Thank you so much, Samuel, for this great presentation. I think it's a topic that we tend not to learn or focus too much on. So thank you so much for today's presentation, and thank you everybody for participating. I am keeping track of attendance again, so you don't have to submit anything today.
Oh yes, and then again, if you guys didn't, please feel free to complete our sign-in sheet for Binational of Central California. Again, it really does help us out. And I just put the link back in there on the chat bar.
Yes, I am taking attendance for the question regarding EOP. I am taking attendance and I'm going to enter everything onto Bulldog Connect. So your advisor will know that you attended today's webinar.
Okay. Have a great one.
Bye.